everybody, welcome to our channel, The Joyful Investors. I'm Kathy and this is Hazel. A little bit about ourselves. We are two sisters who started on this investment journey sometime about 6 years ago with the aim to achieve financial independence so that we can have more time to care for the people and to do the things we truly love. This is why we started The Joyful Investor to document our investment journey and to hopefully inspire you so that you can do the same for yourself too.
So today we'll be sharing about how our TJI portfolio performed in 2020 amidst the COVID-19 crisis using our proprietary strategy, the Moneyball Playbook. We'll also be sharing some learning points that we gathered through this recent market crash. Some of you may be familiar with the best-selling book and film Moneyball. It is about the true story of how a baseball manager managed to put together a winning team using low payroll by taking the quantitative approach. We saw some very strong parallels between that approach and what we do at TJI. It is about making the most out of our investment budget by relying on probabilities and taking measured risks. This is the art of how we will be able to win the unfair game. The Moneyball Playbook is predicated on smart value investing combined with options trading. The basic principle of buying stocks at a discount to its fair value may seem simple, but the correct execution is very much of an art than a science. It is about constructing a portfolio that is best positioned to maximize your gains with the given resources and at the same time averting psychological missteps.
The general idea would be to identify a company that meets a good candidate for a mid to long-term investment, selling at an attractive price. It's essential for this chosen company to collectively march forward so that the capital can be compounded and grow exponentially. The twist is that when the company becomes overvalued due to sentiments, we'll trade out of it and we'll come back in again when there's a good margin of safety from its intrinsic value. This is a slight deviation from pure value investing because while the premise is that we are good to hold it for long term, should the stock becomes overvalued, we are happy to let it go and to find the next candidate. To achieve this strategy, we use both value investing and options trading. So which brokerage platform do we use? For US market, we have accounts with TD Ameritrade, 80% stock investing and 20% on options trading, and Interactive Brokers, 50% stock investing and 50% on options trading. For Singapore markets, we use the DBS Treasures and DBS Vickers.
So without further ado, let's take a look at our portfolio performance and some of the learning points that we gathered through this recent market crash. For TD Ameritrade, we started off with about 201,000 USD on 1st January 2020. And on the last day of 2020, we entered off with a net liquidating value of about 274,000 USD. So that is up by about 73,000 USD, which is equivalent to 96,000 SGD. So this translates to a year-on-year return on investment of 36%. For Interactive Brokers, our initial portfolio was about 111,000 SGD. We ended with 348,000 SGD with a net 60,000 top up during the year. With that, we achieved a year-on-year ROI of 89% for 2020. As you can see, we did multiple lump sum top ups, especially during the crash, and we also had some withdrawals along the way. At that point in time, we also closed off some of our fixed deposits accounts, which we intended to deploy in times of crisis. We never know when a market crash will come, but we must always stay prepared by saving up sufficiently whenever we can. But let's face the truth, we may not be able to save up sufficiently to catch every single market crash or every price correction because we are limited by our monthly income and expenses. This is why we emphasized earlier in our Moneyball Playbook that we'll close off some of our positions whenever we see that the prices are overextended, so that we have our bullets ready when presented with the next good opportunity.
From July to September 2020, we continue to add further to our Singapore position by drawing from the US market. That's because we felt that the US market was a little overextended, while the Singapore market was still pretty undervalued. For those who are wondering, we do not have a Singapore position before this, as we focus more on value investing and growth. But as we saw the potential capital gain to be reaped, we drew out 30,000 Sing dollar from our interactive broker account and deployed them into the Singapore REITs market. And eventually, by early November 2020, the Singapore market started to gain more momentum and move outwards. The initial focus was to allocate majority of the funds into the US market, as it should poise to recover sooner than the Singapore market, since many of the companies in the US market are COVID-proof as compared to the makeup of company in Singapore, especially in the technology sector. Learning point 1. The important lesson to learn in a crash is to be invested in those that recover the soonest, to capitalize on those gains, and then to move on to the others that were likely to follow suit as well. So let's look at how our Singapore portfolio performed. For DBS strategies, you can see that our gains are about 16.7%, while over at DBS Vickers it's about 17.5%. We did not manage to take a screenshot by the end of 2020, but we can do just a simple calculation by subtracting 2%, which is the STI growth for beginning 2021 till date. That gives us about a portfolio return of 15% for 2020. Combining our US and Singapore portfolio, we managed to get a total return of 350,000 Sing dollar, including the dividends from Singapore REITs.
Let us now take a look at the US and Singapore market performance itself. In investing or trading, it is always important for us to compare our performance against a benchmark. This is because if we do not manage to beat the benchmark, it only means to say that we will be better off by just investing in the index ETF itself. The US market ended at a record high at the end of 2020, up by about 15%. Both our US portfolios managed to beat the index. For the Singapore market, let's take a look at the STI. Unfortunately, it ended at around 10% lower. But for our portfolio, it was up by around 15%. And here we are talking about the difference of incurring a loss of 10% versus reaping a return of 15%. Learning point number 2. Be greedy when others are fearful. This had been possible because we added in positions during the crash. Had we been fearful and let our emotions guide our investment decisions, we may end up performing similarly to the indexes or even worse off. Never be confused between the stock market and the economy, because the stock market is never the economy. Buy only the right companies that you know will turn around once the crisis subsides, and we will enjoy the eventual ride-up. For the new investors who only got into the market after the crash, you'll be sitting on some very handsome profits right now. But do remember, the true test only comes when you experience the drawdowns during your investment journey. So remember to stay true to your cause when the time comes.
We hope this video shed some light for you, and we can all eventually emerge stronger after the next crash. Because such market crashes will never be the last one, and it's not uncommon to see them once every 10 years or so. Doing well is about being totally prepared, skillfully and psychologically when the opportunity arises. Thank you for watching, and do remember to comment, like or share our video. To your success, this is TGI signing off.